Uncertainty continues to rattle global stock markets due to Donald Trump's wide-ranging trade war.
This sort of breakdown occurs only about once in a lifetime.
The worst two-day streak for the market since the early days of the COVID pandemic.
Millionaires are made during stock market downturns, and the bigger the decline, the bigger the opportunity, especially if we can be greedy when others are fearful. That's the best way to get rich without getting lucky. So in this video, I'll cover everything you need to know about President Trump's tariffs and which stocks could win big as a result. Your time is valuable, so let's get right into it. Look, I'm not here to waste your time, so here's what I'll cover in this video. Why stocks are still dropping after President Trump paused tariffs, the huge opportunity that creates as companies start reporting earnings, my strategy for being greedy when others are clearly being fearful, and of course, which stocks I'm buying as a result. This is a once-in-a-lifetime opportunity. So let's talk about the overlap between Trump's tariffs, earnings, and this stock market crash. The S&P 500 just had its third best day in history, skyrocketing almost 10% after President Trump announced a 90-day pause on his latest round of tariffs. The Nasdaq also rocketed up by 12% in a single day, marking its second best day ever. And even though the president publicly posted that this is a great time to buy, the stock market seems to disagree because it started erasing those gains the very next day. That actually surprised me, so I started researching what happened after some of the other best days in stock market history, and what I found surprised me even more. This is a table of the 10 largest single-day gains for the S&P 500, going back to when it started in 1957. And April 9th was indeed its third best day ever. But check out the other 9 dates on this list. October and November 2008 were near the bottom of the global financial crisis. March of 2009 was the bottom of that crisis, just like March and April of 2020 marked the bottom of the crash from the pandemic. October 21st, 1987 was just 2 days after Black Monday. That means all 10 of the S&P 500's best days were in the middle of its biggest crashes. And just to make sure I'm not crazy, I also took a look at the Nasdaq. April 9th was the second best day ever for the Nasdaq, and we can see some of the same dates as with the S&P, like the financial crisis of 2008 and the pandemic in 2020. But the Nasdaq's other 5 best days were during the dot-com crash, which happened between 2000 and 2002. The dot-com bubble actually bottomed out in October of 2002, which means the Nasdaq fell another 50% after these 5 best days. It turns out that the stock market's best days are always during its worst drawdowns, which is why nobody should be blindly buying the dip. That's just not a good investing strategy, and I'll share my strategy in a little bit. There are 2 big reasons that stocks are still dropping even after President Trump paused reciprocal tariffs. First, he increased the tariff rate on all goods from China to 145%, and he still kept the 10% universal tariff on other imports. That means the costs of importing materials, parts, and products just went way up for every US company, especially on anything made in China. And higher costs means lower profits. On top of that, China just placed 84% retaliatory tariffs on US goods.
Just today, China increased its tariffs on U.S. goods to 125%, and that is in response to Donald Trump's new tariffs that were announced yesterday that boosted duties on Chinese goods to 145%. This back and forth in Trump's overall trade war has caused big swings on stock markets all week.
Which is terrible for direct-to-consumer companies like Apple and Tesla, since China is one of their biggest markets. The second reason that stocks are still falling is uncertainty. Remember, President Trump didn't end this global trade war. He just paused it, and only for 90 days. That's not nearly enough time for companies to find new vendors, onshore jobs, or build factories in the US. So their only other option is to pass these added costs on to their own customers. That leads to higher prices, which means lower consumer spending, which leads to lower earnings for these companies and ultimately lower stock prices. Lower margins and higher uncertainty are the 2 big connections between Trump's current tariffs and the stock market crashing. But increased costs, lower demand, and more uncertainty create a third and even bigger problem, and that's earnings. Companies typically give guidance or a range of future expectations for things like revenues, earnings per share, gross margins, and capital expenditures. But all of these numbers can only be predicted if a company's leadership or Wall Street analysts can actually calculate the costs of supplies and customer demand. So I expect to see some pretty vague and conservative guidance numbers from this next round of earnings calls thanks to all these tariffs. But remember, the underlying businesses aren't changing nearly as much as the stock price. Nvidia is still Nvidia, and Google is still Google. So all of these unusual earnings calls could make for some serious opportunities to buy great companies at even greater discounts, especially since investors are being extremely fearful right now. Speaking of which, before I even check the stock market, I always check the Fear and Greed Index first. And right now, it's showing extreme fear. In fact, according to the one-year timeline, investors have been extremely fearful since the end of February. So not only is this one of the lowest ratings for the index all year, but it's also one of the longest periods of extreme fear that I've ever seen, which is good information for anyone looking to be greedy when others are fearful. The reason that I check this index first is it's actually an average of 7 solid market indicators like stock price momentum and market breadth, the current ratio of puts to call options, market volatility, and the relative demand between stocks and bonds. So I'm getting a lot of great high-level information on the market all in one place. Like I said in my previous tariff videos, the 3 metrics that I check the most are market momentum, market volatility, and safe haven demand. Market momentum compares the S&P 500 to its 125-day moving average, making it a backward-looking indicator. There are roughly 250 trading days a year, so this is really a 6-month moving average. And the distance between this average and today's price tells you how much momentum the market currently has and in which direction. Momentum spiked after President Trump paused tariffs and then reversed the very next day. These kinds of fakeouts are why randomly buying the dip can be a bad strategy. So my plan is to keep building cash until I see market momentum make a steady climb out of extreme fear territory. That way I know I'm not working against the rest of the market. The VIX measures the S&P 500's volatility, or how much the price is expected to move up and down based on options contracts over the next 30 days. That makes it a forward-looking indicator. Volatility usually drops as the market goes up, and it skyrockets when stocks start to crash. That means its 50-day moving average tends to be lower during bull markets, higher during bear markets, and has huge spikes when everybody starts panicking. Anything above 30 is considered high volatility, and anything above 40 really indicates extreme fear. We can see a big drop in volatility when President Trump paused tariffs, only to go back up into extreme fear territory the very next day. This is another great indicator that helps avoid fakeouts and bull traps, since it usually takes about a week for volatility to return to normal. The third indicator is safe haven demand, which measures the difference in returns between stocks and bonds over the last 20 trading days. Stocks are riskier than bonds, but they usually generate higher returns. On the other hand, there's more demand for bonds when investors are scared to take on new risks. Said another way, safe haven demand measures the big money that institutions are moving into and out of stocks, and a massive amount of money was leaving the stock market until President Trump paused tariffs. I'll talk more about safe haven demand when I get into the stocks that I'm buying, but I only start buying when the VIX comes back down to normal and market momentum is trending in the right direction. That means I always miss the very bottom of the market, but using this data stops me from investing when I feel the fear of missing out. And trust me, we've all been there. But investing based on data instead of feelings is a great way to get rich without getting lucky. Alright, so far we've covered why Trump's pause on tariffs didn't stop stocks from dropping, the impact these tariffs could have on earnings calls in just a couple weeks, how to tell when the market is being greedy and fearful, and we got a couple great indicators to stop us from getting too greedy too early. I really wanted to get all this info out to you because I'm literally about to catch a plane for my honeymoon, so I'll be gone for the next few weeks. And if you feel I've earned it, consider hitting the like button and subscribing to the channel. That lets me know to make more content like this. Thanks, and with that out of the way, let's talk about stocks. I think every great portfolio starts with a fund. All the data we've covered focuses on the S&P 500, but it works just as well for the NASDAQ. since they have so many stocks in common. For example, Apple, Microsoft, nvidia, Amazon, and Google sit at the top of both indexes. I like the Nasdaq because it only has 100 companies instead of the S&P's 500, so it makes higher highs than the S&P when stocks go up and lower lows when stocks go down. Exactly what I want when I'm being greedy as others are being fearful. And if you're in the US, check out the Vanguard Information Technology ETF, ticker symbol VGT. This fund holds more companies for more diversification, it has lower fees, and it usually makes even higher highs and lower lows over the Nasdaq. I personally hold VGT, but just to be clear, they're both great foundations for any long-term portfolio. Earlier in the video, I mentioned safe haven demand, which measures the amount of money institutions are moving between stocks and bonds. And we know that institutional investors are being extremely fearful right now, especially going into earnings. That means they're not going to turn around and invest in hidden gems or risky small cap companies when they move back into stocks. They're going to buy companies with high free cash flows, balance sheets that can withstand trade wars and tariffs, and big business units that span multiple high growth markets. I'm here to be greedy, not stupid. That's why the first company on my list is Amazon, which is currently trading at a price to earnings ratio of 33. That's the lowest PE ratio it's seen in 2 years. And according to discounted cash flow models like Simply Wall Street's, Amazon is currently 42% undervalued, which means it would have to go up by 72% to hit its fair value today. That's a 72% upside on one of the best run and safest companies on the planet. Like I said at the start of this video, millionaires are made during stock market downturns, and now you can clearly see why. On top of that, I think these estimates for Amazon are actually on the low side, because analysts usually undervalue the growth of Amazon Web Services and Amazon's advertising business. Not only is AWS the world's biggest cloud service provider, but Amazon is actually the third biggest advertising company as well, only behind Google and Meta platforms, which is something I point out every time I cover their earnings. Speaking of advertising, Google is trading at a price to earnings ratio of 20, which is just above its 2-year low. Google stock is currently $155 a share, but DCF models calculate its fair value closer to $260. That would make Google 40% undervalued, which would imply a 69% upside. And just like with Amazon, I think growth estimates for Google's earnings are also on the low side. Analysts expect around 10% earnings growth, but Google's earnings actually grew by 36% last year and 27% the year before that. And that's not even including Google Gemini or all of the awesome AI and chip announcements that they just made during the Google Cloud Next conference, which I'll make sure to cover in a separate video. The one other advertising company I need to mention is Meta Platforms, since DCF models show its fair value at over $880 per share. That makes Meta stock 38% undervalued today, giving it a 61% upside. But Google, Meta, and Amazon aren't just the 3 biggest online services and the 3 biggest advertisers on the planet. They're also 3 of the best AI companies with huge data center infrastructures. And we can't talk about AI data centers without talking about nvidia. Nvidia is currently trading at a PE ratio of 36. The last time it traded this low was in 2019, when it was around $5 per share after adjusting for all the stock splits. DCF models show Nvidia stock as being 25% undervalued, but I actually think it has way more than a 33% upside from its current price. And while I'm away on my honeymoon, I'll be releasing my exclusive interviews with Nvidia's executives from their annual GTC conference. Each episode dives deep into their data center products and prototypes to help us really understand the science behind this stock. So stay tuned for that. And the last company on my list is TSMC, the Taiwan Semiconductor Manufacturing Company. TSMC makes 90% of all advanced chips on Earth, from the chips inside Apple's iPhones and MacBooks, all the way to NVIDIA's data center GPUs. President Trump just lowered tariffs on Taiwan from the 32% that he announced on April 2nd down to the universal 10% rate with this latest 90-day pause. We'll see where that rate ends up over the coming months, but today TSM stock trades at just over $150 per share. while its fair value is closer to $260, which implies a 73% upside from here. So hopefully this video helped you understand why stocks are still dropping after the pause on tariffs, the huge opportunity that creates to buy stocks at deep discounts during earnings season, some great indicators to watch before being greedy while others are being fearful, and of course, some great stocks to buy when the time is right. Putting all these things together is the best way to get rich without getting lucky. And if you want to see what else I'm buying to get rich without getting lucky, check out this video next. Thanks for watching to the end, even though I gave you everything up front. And until next time, this is ticker symbol U. My name is Alex, reminding you that the best investment you can make is in you.